enters the office wearing a mask. A senior, Gautam, sits beside her. He asked her why is she wearing a mask as COVID is over. Anisha said the mask is for pollution. The AQI level is so high, it's difficult to breathe. Gautam said it's true that the pollution is so high. Anisha asks why the government doesn't do anything about it. Gautam replied that the government is doing what it can on its level, but citizens should also chip in. But Anisha got confused. What can they do? Gautam stated they should promote those companies that are concerned about pollution and invest in them. Anisha said that it would be very difficult to find those companies. Gautam gave her easy way out by telling her about ESG funds. Anisha got curious about ESG funds. ESG stands for Environment, Social, Governance. In this, investment is made in companies that perform well on environment, social and corporate governance parameters. Generally, a company's objective is to earn profit. In such cases, companies that are working good on environment, social welfare and corporate governance parameters should be promoted. In order to attract common people towards such companies, ESG funds are brought. In many countries around the world, funds that invest in companies that perform well on the ESG standard are quite popular. This is a relatively new concept in India, and most ESG funds have only been introduced in the past 2 to 3 years. Until now, such funds were categorized as thematic equity funds, but SEBI has approved a new category in its board meeting on March 29, which will be called the ESG category. ESG funds will now be placed under this category. In thematic funds, 80% of investments are made in shares of one theme. Asset allocation of ESG funds is mainly based on bonds and shares selected on the basis of environmental, social, welfare and corporate governance. The selection of shares in them is based on strong ESG research. Fund managers invest in companies that are performing well financially and whose positive impact on society can also be seen. Now the question is, how to determine if a company is truly performing better on the ESG standard? SEBI has announced the beginning of the Business Responsibility and Sustainability Reporting Score, which is the BRSR score. The score will have several key performance indicators, KPIs, that listed companies must achieve a valid score for. SEBI has mandated the disclosure of ESG based on this report for the top 1,000 companies. Such companies will need to include business responsibility and sustainability BRSR reports in their annual reports. SEBI has said that ESG funds must invest at least 65% of their assets under management in companies that have been assured BRSR score assurance. As per the rules, companies that do not provide BRSR reports from October 2023 will not be able to receive ESG fund investments. Now you might wonder what kind of investors prefer investing in such funds or companies. Should you invest money in such funds? Many investors trust that ESG-focused companies have better growth potential, which means their investors can also make good money. These companies also demonstrate better resilience during downturns. ESG funds carefully evaluate companies and make investment decisions in shares of ESG-compliant companies. This means that ESG fund managers do not invest in companies engaged in socially and environmentally harmful businesses such as tobacco, alcohol, gambling, or companies with low governance standards. Now the question is, on what basis fund managers choose companies? After selecting companies that comply with ESG standards, fund managers usually make investment decisions based on fundamental analysis. For this, a company's business, management, and valuation are taken into account. The emphasis is on the company's ability to provide long-term profits, the quality of its corporate governance, and whether its valuation is appropriate or not.
So ESG is a new theme, and ESG stands for environmentally conscious, socially responsible, and companies that have good governance. Earlier, this theme used to be called socially responsible investing. Now it's called ESG. The theme has existed for quite long, but it is becoming popular now in the last few years because most institutions like pension funds, like retirement funds, life insurance companies which are dealing with long-term money and public funds, they want to invest in these kind of companies which basically are not destroying the environment or not destroying the society. And so fund managers, when they are investing in these companies, which are these companies, those companies which score high on these ESG parameters, are the companies which are selected in the ESG space, in the ESG funds.
Fund managers believe that environmental, social, and governance issues have an impact on the risk and return of investments. Therefore, they closely monitor companies that they can invest in actively with a deep focus on such issues. However, the parameters for selecting shares of different fund houses may vary. So, what kind of returns can be expected from ESG funds? There is not enough data available on the returns of ESG funds as most of these funds were launched in 2020. According to Value Research, these funds have given an average return of negative 2.4% in the past year, 23% in the past 3 years, and 12% in the past 5 years. Now the question is, should you invest in these funds? So, keep in mind that ESG mutual funds, like other thematic funds, can be quite volatile. They typically have around 80% equity investments, so it's clear that they carry a considerable amount of market risk. The holdings of most of such funds include shares in banking, financial services, information technology, and consumer staples such as food, beverages, and personal hygiene products. Experts say that you can get exposure to such shares from other categories of equity mutual funds as well.
So ESG is a good theme. So of course it is right to invest in these kind of funds, but people need to be very aware that these funds may or may not track the indices well. Okay, so if Nifty is giving, let's say, a 20% return, these funds may end up giving only 12 or 13% return. But those investors who do not want to compromise on these values, they are very, very conscious about the environment and the society, and therefore they don't want to compromise in these values when they're investing. Those kind of investors can come and invest into ESG funds, but with a mindset that this money is for long term. They are not looking at any short term horizon. And second, these funds can basically give much lower return than index, or they may keep in line with index, but that's something which is not a concern or not a parameter to invest. Investing in these funds is basically limited to earning modest returns in companies which are scoring high on ESG parameters.
ESG funds have been launched in recent years in India. Therefore, their track record is not very attractive. Looking at the 1-year return, most funds have not performed well. If an investor is interested in the ESG concept and believes that companies of this type will grow in the future, they should invest in such products. However, if an investor is unfamiliar with the risks associated with such funds, they should first try to understand this concept well and then invest in them. If you're still confused about it, you can consult your financial advisor.